All right, in this lesson, we're going to go through an example. In this example lesson, we're going to be looking at journal entries related to the income statement. So that's what we're going to do. Let's go ahead and dive right in to see what our question asks us to do. So Polar Pop here has these following transactions. So on June 2nd, Polar Pop issues $15,000 in stock to shareholders who is excited to be part of this company. The shareholder pays in cash, and the cash is deposited into the bank. June 28th, Polar Pop receives a bill for trash services in the amount of $118, which will be paid next month, not this month. June 28th, Polar Pop performs $8,000 worth of services to customers on account. And then another June 28th, Polar Pop incurred and paid wages for the current month in the amount of $3,500. Finally, on June 29th, Polar Pop pays $450 to a transportation services company that they rendered the week for transporting employees from an offsite event from the corporate offices. And it's asking us to prepare the journal entries for Polar Pop. So let's get started here. We're going to go through each one individually and then do the journal entries, okay? So let's take a look here. June 2nd, Polar Pop issues $15,000 in stock to a shareholder that is excited to be part of the shareholder of Polar Pop Inc. And that cash is deposited right into the bank account the day that the stock is issued to the new owner, or to a new partner, I guess you could say. So in this case, we still have kind of ways that we can solve this a little bit easier. So let's take a look at what accounts might be affected. So what am I giving up? So I'm giving up ownership in Polar Pop Inc. in exchange for cash. So I know I'm getting cash. So one of the accounts that we're going to affect is cash because we're receiving cash. What did we give up? Well, we gave up stock, right? So when we give up stock, we call that common stock. So common stock, okay? So cash for common stock. All right, so what type of account is cash? Well, cash is an asset. What about common stock? Well, I actually gave up equity, so that common stock is owner's contribution, so owner's capital. All right, so cash, what happens? Does cash go up or down? Well, we received $15,000 from the shareholder, so cash is going to go up. Now, what about common stock? Do we have more common stock? Do we have a less common stock? Well, when we issue common stock, we're issuing more. So we talked about revenues and expenses are like a scorecard. We sometimes think about this as a scorecard. The more stock that we issue, we increase common stock. So increasing common stock as well. All right, so cash is an asset. The asset increases, so we are going to debit cash. And then common stock is an owner's capital. Owner's capital is on the right side of the equation. We're also increasing it, so therefore we're going to credit common stock. So the debit and credit would look like this. For journal entries, the debits go before credits, so we'll do that. Debit cash for $15,000 and credit common stock for $15,000 as well. So that's our journal entry for this first one. Nothing have to do with income or expenses. So we'll move on to the next one where we probably will get something that has to do with income and expenses. All right, here we go. Polar Pop receives a bill for trash services in the amount of $118, which will be paid next month. So what has been exchanged? Well, we gave up an IOU because we haven't paid for it. We will pay for it next month. So we gave up an IOU. Giving up an IOU is called an accounts payable. So accounts payable will be one of the accounts. And what did I get in return? We got trash services. So some people would say, well, trash service expense. The one that we use in business a lot is utilities expense. It's a utility. So utilities expense. Now, if you put trash service expense, it's really not wrong, so you're good there, but utilities expense is a better way to describe it. So accounts payable, that is a liability because I owe it. And utilities expense is an expense. All right, so accounts payable is a liability. Did it increase or decrease? Well, I owe more. Because I owe more, we're increasing this account. What about utilities expense? Well, utility expense is an expense. I incurred more expenses. We said an expense is like a scorecard. The more that I incurred, we increase that scorecard over time. So we're going to increase that expense. All right, so accounts payable is a liability, right-hand side of the equation. That's increasing. We're going to credit the payable. And then the utilities expenses on the left-hand side, it is also increasing. So we are going to debit utility expenses. So for journal entry purposes, debits go before credits. So the debit would be utility expense for $118. And then we're going to credit accounts payable for $118 as well. I'm using A/P as a shorthand for accounts payable. A lot of accountants do that, so you're okay if you do that here. So accounts payable just has too many syllables, didn't want to write it all. You know what I mean, right? So credit accounts payable there. Okay, so that's our second part here in this example. If you don't have any questions, because I can't answer them anyways, let's go on to the next example. Polar Pop performs $8,000 worth of services to customers on account. So the key word here is on account. What does on account mean? That means it's either going to be an accounts payable or an accounts receivable. Now, how do you know which one's which? Really, it comes down to context. Accounts payable has the assumption that we're the company going to have to pay someone. Accounts receivable has the context of we are receiving it. So when you read it, you got to look for the context, and it's either going to be accounts payable or accounts receivable. So on account means that we perform the services, but we haven't been paid yet. Well, which one is it going to be? Accounts receivable or payable? Well, if we haven't received it, we still need to receive it. So it's going to be an accounts receivable. So accounts receivable. And then how do we incur that accounts receivable? Well, we provided a revenue. So in this case, it's service. So we're just going to write service revenue as the account name. All right, so now that we have that, we've got some components. So accounts receivable, what component is it? Well, accounts receivable is an asset because it can yield the company future benefits. So it's an asset. What about service revenue? Service revenue is a revenue account. All right, so accounts receivable, the customer owes us the money. Because they owe us the money, we're increasing our accounts receivable, so we'll increase that. Service revenue is a scorecard. The more revenue that we do, we increase the revenue, so we're going to increase the revenue. All right, so now we can use our key. So accounts receivable is an asset. That asset is increasing. We're going to debit the account. Service revenue is a revenue account on the right-hand side of the equation. That is also increasing. We are going to credit that account. Now it's time to do journal entries. We're going to do the journal entries based on the same rules that we've done. Debits first, credits next. So debit is going to be AR. Credit is going to be service revenue for $8,000. Okay, so that's what it looks like. Okay, debit AR, credit service revenue, $8,000. We've earned the revenue, but we haven't been paid yet. We'll be paid at some point in the future. In this case, probably next month, because most companies have a 30-day kind of lag. Okay, all right, moving on. Polar Pop incurred and paid, so keyword here, incurred and paid, wages for the current month in the amount of, and I scribbled that out, but that's going to be $3,500. So Polar Pop incurred and paid wages for the current month in the amount of $3,500. So what did I give up? Well, I gave up cash, because if I paid it, then cash has to go out. And then what did I get in return? I got employees' time, which we call wages expense. Now you could wages and salaries expense salaries expense. So it really just depends on what's happening here. But just know wages and salaries and salary expense are all the same thing for the most part, okay? So I'm just gonna use wages expense because that's the easiest. All right, cash we know is an asset. Wages expense, it has the word expense in, and it's not a deferred expense or a prepaid expense. So it's gonna be an expense. Cash is an asset. That asset is increasing or decreasing. Well, if I'm going to pay it to the employees, that's going to decrease my cash balance. Wages expense, the more expenses we incur, we increase the expense. So we increase that. Cash is an asset. Assets on the left-hand side. The asset decreases, therefore it's a credit. Wages expense is on the left side as well, but it's increasing, therefore we're going to debit. All right, so debits go before credit, so we'll go wages expense for $3,500 and credit cash because it's coming out of our pocket for $3,500. So that is our entry for that one there. Okay. Hopefully, if you've watched all the lessons in this section, which you probably didn't, but there's a lot of them, I know. There's like 17 lessons in this section. But if you watched all of it, you're probably feeling like at this point, like, I got this. Like, this is just like kind of something that you're just doing, but you got it. That's good. That means that the videos are working, and that means that you've done enough examples. And so, it should come a little easier every time you keep on going. So if you're like, man, just forget the top part and just give me the journal entry because I know how to do the top part in my head, that's good. That's a good sign that you're actually learning that. Now, if you're having a little bit of trouble, that's okay. Practice makes perfect. And so we keep on doing this. In the next section, we'll kind of leave off the top 9, 12 boxes, whatever, how many boxes we have there. And we'll just go straight for the journal entry. So hang in there if you're like, this is a little slow for me. That's okay. You're fine. We got one more problem here. All right. So Polar Pop pays $450 to a transportation company for services they rendered during the week for transporting employees from an offsite location to and from their corporate offices. So what happened here? So the word here is that we paid $450. So cash was exchanged. So we know that cash is going to be one of the accounts. And then the next part here is, what's the expense? Well, in this case, transportation. So transportation expense. And that's usually a common one because that also can include flying employees to different places for meetings or whatnot. So transportation expense or travel expense are things that you're going to see often. So that's definitely okay. So cash we know is an asset. Transportation expense is that expense that we've been talking about. Cash is going to decrease because we're going to have to pay out $450. So that's going to decrease. Transportation expense is an expense. That expense is that's increasing the expenses that we've incurred during the period. So we're going to increase the expense. All right, kind of the same thing as the last one here. Cash is an asset. Asset decreases. So we're going to credit cash. Transportation expense is an expense. That expense increases. Therefore, it is a debit. All right, so then debits go before credits. Debit, transportation expense for $450, and then cash for $450. Okay, hopefully that wasn't too slow. $450, so that's our journal entry there. So that is our example. We've done all the journal entries in this section here, or in this example question here. The key thing again is practice makes perfect. So a lot of these are very much the same as the ones that we did throughout this section, and that's okay. The more you get this, the better you are at it. And trust me, as we go through different sections later on, you're going to need to know how to solve journal entries because that's the main backbone of accounting. So hope you enjoyed this lesson, and we'll see you in the next example in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.